It's a funny old time in the tech market right now. We're seeing a lot of red across the board. The Nasdaq's feeling it. Even those so-called Magnificent Seven aren't looking quite so magnificent lately.
Yeah, definitely some pressure there.
But then you see a company like Netflix quietly going about its business, actually up on a down day. Makes you wonder what's really going on under the surface, doesn't it?
It absolutely does. That contrast, as you say, is really telling. It suggests we need to look beyond the broad headlines and understand the specific forces at play.
For different sectors, different companies.
Exactly. For different sectors and individual companies, that's where the real story lies.
Exactly. And that's precisely what we've been doing for you. We've taken a good hard look at the recent tech news market trends, company announcements, even some juicy legal battles to pull out the stuff that really matters.
Kind of cutting through the noise.
Yeah, think of this as your shortcut to being in the know without having to wade through endless articles.
So today we're going to try and unpack a few key areas. We'll try to make sense of this broader tech market pullback and pinpoint where some potential opportunities might be lurking.
Okay.
We'll also dive into the Google antitrust saga and what's at stake there. That's a big one.
Huge implications.
Then we'll touch on the headwinds Tesla is facing and what investors are, keeping a close eye on.
Right.
We'll explore the fascinating rise of chatbot arena, started as an academic thing, now influencing AI.
Interesting.
And we'll examine why Netflix seems to be weathering the economic storm so well. What's their secret sauce?
Yeah.
And finally, we'll navigate the complex landscape of the semiconductor industry amid all the geopolitical rumblings.
Lots to cover. All right, let's jump right into this tech market sell-off. It feels like just yesterday, everyone was talking about unstoppable growth. What's flipped the script? What are the main anxieties driving this?
Well, a couple of big factors seem to be at play. There's a lot of uncertainty around the Federal Reserve's next moves. Interest rates, economic growth outlook.
Always the Fed.
Always the Fed. And additionally, there's maybe a growing question mark about whether the U.S. will continue to be seen as the unshakable economic safe haven it once was.
So broader macro doubts.
Yeah, these macro-level doubts can definitely trigger a broader market correction, especially in tech, which can be more sensitive.
Right, and we saw analyst Scott Landis offer a perspective on this, suggesting that this dip might be a buying opportunity in tech generally. But he had a specific warning about one area, didn't he?
He did, yeah. While he sees potential for long-term gains by buying into some of the current tech weakness, he's advising caution specifically when it comes to chip stocks.
Semiconductors again. Why is caution there?
Well, the ongoing trade tensions and, tariff uncertainties make that sector particularly volatile right now, hard to predict.
Got it.
However, he remains bullish on the overarching theme of artificial intelligence. AI is still central.
Okay, so AI is still the buzzword, but maybe the focus is shifting a bit. It's not just about who's making the chips anymore.
Precisely. He described a transition from what he calls the infrastructure phase of AI, which was all about building out the computing power, largely through semiconductors, the NVIDIAs of the world.
Right, building the foundations.
To the prove-it stage. Now, investors want to see tangible results. They want companies actually using AI to boost their productivity and improve their profit margins. Show me the money, basically.
So it's gone from build it and they will come to show me how it helps the bottom line when it comes to AI.
That's a very succinct way of putting it. Yeah. The focus has shifted to identifying companies that can effectively deploy AI tools to streamline operations, enhance products, make things more efficient.
And Landis even suggested a specific investment strategy.
Yeah, he proposed a tech investment strategy that gives equal weight to companies across the AI landscape, specifically looking for those demonstrating this kind of productivity-driven growth with AI, not just the infrastructure players anymore.
Okay. And with earnings season underway, it sounds like we shouldn't put too much stock in the usual precise earnings forecasts from CEOs. Like, don't expect exact numbers.
Exactly. The expectation is for more generalized, maybe fuzzy earnings guidance this time around. Given the fluid economic and geopolitical environment, pinpointing exact figures is a real challenge.
So what should we listen for?
What analysts will be paying closer attention to is the narrative. What are the company's operational strategies for navigating this uncertainty? What are their contingency plans, their plan Bs? It's more about the management's vision and adaptability than hitting a specific number for the quarter.
Makes sense. We also touched on capital expenditure those big investments companies make. Is there a lot of clarity on those plans right now? Or is that uncertain too?
Short-term CapEx plans seem to be shrouded in some uncertainty, reflecting the broader economic jitters. People are maybe holding back a little.
Yeah.
However, the longer-term view is what's really interesting. Investors are keen to understand companies' investment strategies for the next 2 to 3 years. Are they still committed to those big bets, particularly in areas like AI infrastructure? And crucially, are they beginning to put those plans into action?
So looking for commitment beyond the immediate wobble.
Exactly. It's about identifying companies with a clear, long-term growth roadmap, even if the next quarter looks a bit hazy. Oh, and also, quickly, there's mention of maybe looking at international equity because of the weakening dollar.
Ah, interesting. And China investment. Still tricky.
Very tricky. Though one potentially positive sign noted was that the common prosperity language seemed to be dropped recently, which some might interpret as less interventionist, but still very complex.
Okay. Now let's pivot to a legal drama that's been playing out for a while. The Google antitrust battle. Can you remind us what the core issue is here?
Sure. At its heart, the Department of Justice has argued, and a judge has now agreed in a ruling, that Google holds an illegal monopoly in the web search market. So the finding of monopoly is there.
Right.
The current phase of the legal process is focused on determining the remedies, basically, what should be done about this monopoly.
And the remedies being proposed sound pretty drastic, potentially breaking up parts of Google. I heard Chrome mentioned.
Indeed. The government is proposing some really significant changes. Forcing Google to potentially sell off its popular Chrome browser is one.
Wow.
Also, making it license more of its search data to competitors. And, critically, stopping its practice of paying billions, literally billions of dollars to companies like Apple to be the default search engine on their devices.
And the judge highlighted those payments, right?
Yes. The judge, in the initial ruling, indicated that those payments were a key factor in maintaining Google's dominant position, effectively locking out competitors.
Google naturally is pushing back hard, arguing that these changes would stifle innovation and actually harm consumers. What's their line?
That's their central argument, that the government's proposed remedies are misguided and would ultimately weaken their ability to innovate and compete effectively on a global scale. They argue it could put the U.S. tech sector at a disadvantage.
It's been a while since we've seen a major tech company face this kind of breakup threat in the U.S., hasn't it? Like a really long time.
It has, yeah. We're talking over 4 decades since the AT&T breakup and, a quarter of a century since Microsoft's big antitrust scrutiny. It's major.
And this Google case isn't expected to be resolved quickly, I assume.
Not at all. While we might see a judge's decision on these remedies maybe around August, most legal experts anticipate years of appeals. This will likely go all the way to the Supreme Court. It's a long haul.
And this feels like part of a broader trend, doesn't it? Regulators taking a closer look at the power of big tech companies generally.
Absolutely. The scrutiny on Google is just one piece of a larger puzzle. Regulatory bodies globally, and particularly in the US and EU, are examining the competitive practices of major tech players. Companies like Meta, Apple, Amazon, they're all facing similar investigations and legal challenges.
We also heard from a former Nebraska Attorney General, Doug Peterson, who offered an interesting perspective on how this impacts consumers. What was his take?
He raised a really crucial point about the vast amounts of personal data that companies like Google accumulate. His argument is that consumers essentially become the product.
Right, the old saying.
Yeah, that data fuels these companies' search engines and now their AI capabilities. He expressed concern about the implications for privacy, but also for market manipulation when so much data, so much power is concentrated in the hands of a few powerful entities.
Google would argue, though, that integrating Chrome with Android, for example, enhances the user experience, makes things seamless, so breaking them apart would be detrimental. What's the counter-argument to that?
Well, Peterson's perspective, which aligns with the judge's findings, is that Google's dominance wasn't achieved solely through offering a superior product or a seamless experience.
Gotcha.
He contends that these exclusionary contracts and strategic revenue-sharing agreements, those payments we mentioned, effectively boxed out potential competitors. They prevented real innovation in search for maybe a decade. So the seamless integration, in his view, came at the cost of a truly competitive landscape. Less choice for consumers, ultimately.
And even with the emergence of AI-powered search like ChatGPT and others, this antitrust battle still has relevance for the future.
Absolutely. That's a key point. The argument is that the underlying data that fuels these new AI search engines is still largely controlled by companies like Google. They have the historical data, the user interaction data.
Oh, right. The fuel is the same.
Exactly. So therefore, even as search evolves into AI chat and whatever comes next, some form of ongoing regulatory oversight might be needed, perhaps even involving monetary processes like forcing them to share data or revenue could be necessary to ensure fair competition in this new AI era. The court might need to stay involved.
Fascinating. Okay, let's switch gears now to Tesla, which had a bit of a rough patch in the stock market recently. Big drop.
That's right. Tesla's stock price saw a significant drop, over 7% in one day, which marked its worst day since, I think, April 10th. So, yeah, noticeable. And it caught the attention of even some of the most steadfast Tesla bulls.
We even heard one prominent analyst issue a code red warning. That sounds pretty dramatic. What was his main concern? What's the code red about?
His warning was essentially a plea, really, for Elon Musk to refocus his attention. The analyst is urging Musk to prioritize bolstering Tesla's core business-boosting sales, delivering that long-promised lower-priced EV, the Model 2 or whatever it'll be called, and pushing forward with autonomous vehicle technology. Instead of being perceived as primarily focused on, say, government cost-cutting initiatives or other ventures, the fear expressed is that the brand itself could suffer lasting damage if these core EV and autonomy areas are seen as being neglected.
It feels a bit like déjà vu, doesn't it? Investors getting concerned about Musk's attention being spread too thin across his various companies and interests.
There are definitely parallels people are drawing to past periods. Investors worried about his time spent at SpaceX or the Boring Company. The current concern seems to be that his engagement with various government-related efficiency projects, while perhaps laudable in isolation, might be perceived as taking focus away from the fundamental drivers of Tesla's growth at a critical time.
Especially since the competition in the electric vehicle market is really heating up, right? Particularly on things like charging speed.
That's a crucial point. Other EV manufacturers, particularly in markets like China, are making significant advancements. We're seeing faster charging tech, different battery chemistries, new models hitting the market constantly. That puts increasing pressure on Tesla to innovate and maintain its competitive edge. They can't rest on their laurels.
We also had a brief mention of Hertz, the rental car company, and their past experiences with Tesla, but a potential upside with rising used car prices due to tariffs. Can you unpack that quickly?
Yeah, it was an interesting side note. Hertz previously reported substantial losses because they bought a lot of Teslas and then had to sell off parts of their fleet at lower than expected prices when the market shifted.
Right, they got burned a bit.
They did. However, the potential silver lining now is that if tariffs on new vehicles, potentially including EVs from China, drive up prices for new cars,
then used cars become more valuable.
exactly. The value of Hertz's existing used car fleet, including their remaining Teslas, could increase. This might allow them to potentially recoup some of those earlier losses when they eventually sell those vehicles. A potential, albeit complex, tailwind.
Okay, interesting dynamic. Let's move to a more recent development in the AI space, Chatbot Arena. It started as an academic project, but is now evolving into a company. That's quite a trajectory.
It is indeed. Very interesting story. Chatbot Arena began as a research project within the Sky Computing Lab at UC Berkeley, but it quickly gained a lot of traction, became quite popular online as a unique platform.
What does it do exactly?
It lets users anonymously test and compare different AI language models, often new ones, sometimes even unreleased ones. Users interact with two anonymous bots side by side and vote on which one gave a better response.
Ah, like a blind taste test for AI.
Exactly like that.
Right.
And these votes contribute to a publicly visible leaderboard ranking the models based on this crowdsourced human preference.
So it's essentially a democratic or at least crowdsourced way to see which chatbots users actually find the most impressive or helpful.
Precisely. And this crowdsourced evaluation process has generated a massive amount of data. The report mentioned, 2.8 million user votes already?
Wow.
This data is incredibly valuable to AI companies. It gives them direct insight into user preferences for their models compared to competitors, information that's otherwise really difficult and expensive to obtain at scale.
And it's not just random users, right? Even major players are paying attention. I heard OpenAI used it.
That's right. It was noted that OpenAI has used Chatbot Arena to test models, sometimes models that weren't even public yet, before a broader release. That speaks volumes about the perceived value and credibility of the platform's feedback.
So it went from university lab project to influencing big tech AI development.
Pretty much. The platform's ability to provide relatively unbiased, real-world user feedback in a competitive head-to-head environment makes it a very attractive testing ground. And now, to handle this growth and presumably secure funding and scale operations, it's being formalized as a company.
Who's behind the company? The original researchers.
Yeah, it mentioned that some of the graduate students from UC Berkeley's Sky Computing Lab who initiated the project are involved as co-founders, from passion project to startup.
Cool story. Now let's talk about a company that seems to be navigating the current economic uncertainty with remarkable strength. Netflix. They've reported record profits. Their stock is performing well, near highs. What's their secret right now? Why are they looking so resilient?
Well, Wall Street increasingly views Netflix as a relatively safe harbor, a sort of haven stock in the current choppy economic climate.
A haven. Why?
A couple of reasons. First, they are perceived as being less vulnerable to the direct impacts of things like tariffs compared to companies dealing with physical goods and complex global supply chains. Second, their subscription-based model is seen as somewhat recession-resistant.
Because people won't cut their Netflix subscription.
Well, entertainment, especially affordable home entertainment, is often one of the last things consumers cut back on during tighter times compared to maybe more expensive discretionary spending, so it's seen as more resilient.
And financially, they've really turned a corner, haven't they? There used to be worries about their debt and spending.
Absolutely, that's a huge part of the story. Over the past couple of years, Netflix has consistently over-delivered, exceeded expectations in terms of generating free cash flow and profit. They've effectively addressed those earlier concerns about their debt levels and cash burn. This financial stability is a significant factor driving current investor confidence.
They're also making massive investments in content creation all over the world. How is that global strategy contributing to their resilience?
Their extensive global production network is key. They're producing content in, around 50 countries now, and their annual content budget is huge, reportedly exceeding $18 billion now, which is more than any other streaming service.
How does spending more make them safer?
It's about diversification and scale. By producing a high volume of diverse content globally, they significantly increase their chances of creating those massive global hits, think Squid Game from Korea, or Adolescence may be mentioned here, which attract and retain subscribers worldwide.
More shots on goal.
Exactly. Plus, producing content internationally also provides some insulation against currency fluctuations and tailors content to local tastes, driving growth in different regions.
Live content has proven to be a tricky area for streaming services. Technically difficult. How is Netflix navigating that? Are they going big on sports?
Scaling live streaming is definitely a complex technical undertaking. Netflix has acknowledged challenges, but also shown they're learning and improving. They streamed NFL games on Christmas Day, for instance, which seemed to go well.
So more live stuff coming.
They're experimenting, certainly. It complements their core on-demand offering, especially as they expand their advertising-supported tiers where live events can be valuable. But it seems unlikely that, say, major sports rights will become their primary focus. It's probably more opportunistic.
Gotcha. Looking ahead, what are the key drivers analysts see for Netflix's future growth? Where does the next wave come from?
A major factor highlighted is the potential for significant subscriber growth in the Asia-Pacific region over the next 5 to 10 years.
Untapped potential there.
Relatively, yes. Their penetration in that vast, diverse market is still lower compared to more mature markets like North America and Europe. Successfully replicating their growth strategies in various Asian countries is seen as critical for their continued long-term success story.
Makes sense. Okay, finally, let's delve into the semiconductor industry. It's increasingly at the heart of geopolitical tensions. We're seeing export controls becoming more stringent, aren't we?
They are indeed. It really reflects how fundamentally strategic semiconductors have become. They're crucial for everything from smartphones and AI servers to advanced defense systems.
So governments are getting much more involved.
Absolutely. Companies like NVIDIA, which designs the most advanced AI chips, and key allied chip manufacturers like TSMC in Taiwan are operating right at the intersection of technological innovation and intense international security concerns. The rules keep changing.
And TSMC, which produces the vast majority, like 90% of these advanced chips, has even admitted that it's challenging to track exactly where their chips end up. That sounds problematic.
It does raise serious questions. Given TSMC's dominant, almost chokehold position in advanced semiconductor manufacturing, some argue they have a responsibility, maybe even a leadership opportunity, to enhance transparency and traceability within their supply chain.
To prevent chips ending up where they shouldn't. like in sanctioned products.
Exactly. There were mentions of reports about chips, potentially TSMC made, ending up in Huawei products despite restrictions. Improving supply chain visibility is a growing demand.
NVIDIA has been trying to adapt to these changing regulations by designing modified, slightly less powerful chips specifically for the Chinese market to comply with U.S. export rules. What are the long-term implications or criticisms of that strategy?
Well, there are ongoing debates about the long-term wisdom of that approach, constantly creating specific, perhaps slightly hobbled products just to comply with the demands of one particular regime, especially when national security interests are explicitly cited as the reason for the controls. It's tricky.
Kind of walking a tightrope.
Very much so. Plus, China has its own stated goal of achieving self-sufficiency in critical technologies, including semiconductors, by 2035. That creates a sort of ticking clock for American chip companies relying heavily on that market. The argument is increasingly being made that the strategic focus should be on maintaining U.S. technological superiority and deepening collaboration with trusted allies, not necessarily catering indefinitely to China's market under these conditions.
Despite these pressures, NVIDIA's CEO, Jensen Huang, recently visited Beijing. That seems like a delicate balancing act, given everything.
It is an extremely complex situation. China remains a significant market for NVIDIA's products, no doubt. But navigating that while adhering to U.S. regulations and prioritizing collaboration with trusted international partners and allies like Japan, which Huang also visited, is crucial. It's about safeguarding collective security and advancing shared technological goals with reliable partners.
There's always the counter-argument, though, that these export controls might simply accelerate China's own efforts to develop indigenous semiconductor technology. Does restricting access actually work, or just spur them on faster?
That's the classic debate. The prevailing view, often presented by policymakers pushing for controls, is that China is already heavily invested, spending billions, in pursuing technological self-sufficiency. They're going to try anyway.
Right.
So the argument goes, providing them with access to the most advanced existing Western technologies would simply save them time and resources, shortening their timeline to catch up or even surpass in some areas. Therefore, the more effective strategy for the U.S. and its allies is to continue to innovate aggressively themselves, stay ahead, and control access to the most critical enabling technologies. Don't make it easier for them. So, as we kind of wrap up this deep dive, we've really navigated a pretty complex landscape today.
Yeah, definitely a lot going on.
From the shifting sands of the tech market, the AI prove-it stage, to that protracted Google antitrust battle.
Tesla's moment of needing to recalibrate, maybe.
The surprising emergence of chatbot arena from academia, Netflix's steady performance amidst the storm, and finishing with the really intricate world of semiconductor geopolitics.
And hopefully, weaving through all that it's giving you, our listener, a clear understanding of some of the key trends shaping the tech world right now, without getting totally overwhelmed by, all the details.
Indeed. And I think recognizing how these seemingly disparate stories are actually interconnected is key.
How so?
Well, think about how geopolitical tensions directly impact market dynamics and company strategies, like with chips. Or how antitrust actions against Google could reshape the future development and competitive landscape of AI. Or even just how basic consumer behavior influences the success of streaming giants like Netflix. It all ties together.
Right, it provides invaluable context in this, incredibly rapidly evolving technological era we're living in.
Couldn't agree more.
Okay, and on that note, here's a final thought for you to ponder as we sign off. Considering all these interconnected forces we've discussed, the market shifts, AI evolution, regulation, geopolitics, consumer trends, what single development do you believe will be the most significant game changer, the biggest disruptor in the tech landscape over the next 5 years? Something to think about. Thanks for joining us for this deep dive.